Good morning. Welcome to Get Ready for the Next Stage of China's Growth, a 1 hour program brought to you by Citywire and Fidelity International. My name is Jeremy Gordon, I'm from Citywire, and I'll be presenting today's broadcast with my colleague Michelle McGarr. In a minute, I'll introduce our speaker, Dale Nicholls, Portfolio Manager of Fidelity China Special Situations PLC. Based in Hong Kong, but joining us today from Singapore, Dale has been at Fidelity since 1996 and has managed the £2 billion investment trust since 2014. The Chinese equity portfolio is all about giving investors exposure to the rapid growth of the Chinese middle class and domestic consumption. China's stock market surged last year as its economy emerged quickly from the coronavirus pandemic. The trust rode the crest of that wave, driven by the dynamic technology businesses which epitomise what Dale calls New China. But that environment has started to shift this year, with something of a pullback and a rotation towards less glamorous sectors. And I'm looking forward to hearing today how Dale's approach to capturing China's growth has been evolving, including the trust's increasing investment in private companies before they list on the stock market. Hello Dale, thanks so much for joining us today. How are you?
Very well, Jeremy. Great to be here and great to have a chance to connect with everyone.
Excellent, thank you. Well, before you start your presentation, Dale, we have a quick question for the audience. Do you currently invest in a China-specific fund? That's China-specific fund or investment trust, I should say. Two options here, yes or no. And as a reminder, look for the vote here link to vote in that poll. Dale, while the results are coming in, I've got a quick question for you. You also run an open-ended fund investing in the wider Pacific region too. From your perspective, which do you prefer, open-ended funds or closed-ended investment trusts?
I would say definitely the closed-end vehicle, just given the flexibility that it offers, and not having to worry about flows. I can sort of access the opportunities. I can adjust the gearing as I need to. And obviously, we have a broader range of things that we can invest in as well. We can short, we can invest in unlisted companies. So, bottom line, the flexibility that it gives, I would definitely say, the closed-end vehicle is my preferred.
Okay, well, thanks very much, Dale. Okay, so I think the results are nearly in, and it looks like a very engaged audience today. The vast majority of people already investing in China funds, so I'm sure they'll be very interested to hear what you have to say, Dale. And so on that note, if I could ask you please in your own time to start your presentation.
Absolutely. If we can just move to the first page. Great. So Jeremy, your first question is very present. If we go to the next page, I'm going to touch on some of the points, maybe one more. I'm going to touch on some of the points about the trust. I guess, a lot of the things that we're talking about here are consistent across a lot of investment trusts. But I think for this trust in particular, we really try to leverage all the tools at our disposal to access the broadest range of opportunities in China. So obviously the closed-end structure, we definitely leverage that. That allows us to invest in more illiquid, smaller cap types of companies. Again, without that concern about flows working against you. We have the gearing. We have separate slides just on sort of how the gearing has changed over time, but we really try to leverage that. And it's, I guess, at a relatively high level now of 119%. That's net gearing, which reflects the opportunities that we're seeing on the ground. We have the ability to short as well. We obviously, we have a very strong team that's covering all the opportunities. So it makes sense to access all that research to sort of capitalize on the opportunities on the downside as well when we think there are opportunities. And then finally, you have the unlisted portion of the portfolio, which has, I think, obviously it's down a little bit recently with recent listings, but the general trend has been moving up. And as I mentioned, the focus is on accessing the broadest range of opportunities in China, and a lot of the opportunities are still private. We can delve into more of the portfolio later. Next slide, please. So, the biggest strength, I think, of our our whole process and the trust and the way we invest is the team on the ground. So you can see the portfolio managers that we have. Obviously the team that I work most closely with is those 24 analysts, and they're spread across different parts of Asia. We have them in Shanghai, Hong Kong, and Singapore. Mostly focused specifically on China. Some have broader mandates. For some mandates, it makes sense to look a bit more broadly. But this is the team that I interact with daily. They're out there, with their specific coverage of companies, and they're out there looking for opportunities. And I think, in particular, I'd highlight the team in Shanghai. As we'll get to, and as you probably know, life on the ground in China is very much back to normal. So, during this period where a lot of countries are locked down, our team is out there on the ground, meeting companies, meeting suppliers, meeting customers, and doing the work on the ground to sort of build conviction on the companies that we're investing in. Next slide, please. I wanted to just give a quick overview of the core things that I focus on in any investment, just to sort of give you some background there. When I say scale, the first point, really just thinking about the potential scale of a business. How big can it be in 5, 10, 15 years? Just given the opportunity set and how well a company is positioned. Secondly, returns. So there's a lot of companies out there that grow significantly but don't generate great returns. So I'm really focused on incremental returns on capital, free cash flow generation, and the core there is really understanding core competitive advantage, a company's moat, and how that's changing. Next, we have management. So you can have the business and you can have the opportunity, but management needs to execute. This is why we spend a lot of time with management teams, understanding how they view the potential, the strategy, and we're constantly evaluating how they're executing on that strategy. And finally, by tomorrow's gems, again, leveraging the ability to invest in companies earlier in the trust. We try to be ahead of the market, identifying the opportunities early. We find generally with smaller companies, there's less information, and with less information comes more mispricing. And obviously, we're in the business of owning mispriced companies. So we try to be early in identifying those opportunities, and that's what leads to a sort of mid to small cap bias in the trust. Next slide, please. Just to illustrate this a bit further, you can see how the sort of style distribution breaks out for the trust versus the index. So you can see we're a lot more diversified across the different categories. So obviously you see that sort of mid to small cap bias there coming through, and it's also relatively broad in terms of growth versus value. Obviously in the last couple of years, I would say, although it's changing recently, we've had a relatively narrow market. So I think that large growth sort of portion of the market has clearly outperformed. But at least in the last few quarters, we're seeing things starting to broaden out, and so I think we're relatively well positioned to capitalize on that sort of broader trend in the market. Next slide, please. And now we're just looking at how the gearing has moved over time. So again, this is something that I really value in terms of sort of being opportunistic around moves in the market. And you can see how the net gearing has changed. And it's not a pure inverse relationship, but I guess we shouldn't be surprised that at times when the market is down, that's presenting more opportunities, and that's when you see sort of gearing tend to move up, and vice versa. So you can see how the market has done overall. So obviously it's been a strong year or so for the market, and that's why part of the reason you see gearing, I guess, generally trending down. Some may question whether that should actually be lower given what markets have done, but it just again reflects the opportunities that we're seeing in the market. There's still definite pockets of value out there in the market, and that's what sort of leaves the net gearing relatively high. And I should say those opportunities again are coming through in both the private and in the listed space. Next slide, please. So here we're showing the performance over time. it's been a good 12 months. I think that partly reflects the fact that the market has broadened. I think in terms of other factors, driving this, clearly, as Jeremy mentioned, that focus on the sectors in the market that we know are going to be bigger parts of just the Chinese economy in general over time has helped. So obviously the consumer, areas like healthcare, the tech space, these are what we generally define as new China, the areas, again, that we think are going to be just generally bigger parts of the economy over time. But what's also encouraging is the stock picking contribution that's coming through, and I think the team has done a great job of sort of identifying these opportunities. And I must say, there's some names in the portfolio that we've really had for some time we thought were undervalued, and has only sort of recently been recognized. So it's good to see that those types of names really come through in the performance. In addition to that, there's some new areas that have increased weighting in the portfolio that have also clearly contributed over the last 12 months, and I'll touch on some of those. Next slide, please. So, just in terms of valuations, I mean, we've seen what the markets have done. So, not surprisingly, if you look at sort of overall valuations for the market, they're clearly not as compelling as they were 12 to 18 months ago. You can see how sort of the overall valuations for the market have moved up. Couple of points I'd make here. Obviously we see compared to the US market, I still think China looks pretty compelling on a relative basis. You can see the sort of valuation gap there for growth. For growth, which I think is at least comparable, if not better. I'd also make the point that if we look at the valuations for the trust itself, just sort of given the move up we've had in markets, the valuations for the trust have moved closer to the benchmark and are roughly in line, maybe slightly above currently, as we've taken money off some of the more extended parts of the market and rotated that into areas that we think offer better value. And then on the right, again, I sort of talked about the sort of narrowness of the market. We're looking at sort of a large cap multiple versus small cap. We've been through this period where the large caps get much more expensive relative to small cap, but you can also see that over the past few quarters that started to adjust. So again, given how we're positioned, I would hope that sort of acts as a tailwind if that continues looking forward. Next slide. So moving on, just to sort of set the scene more broadly from a macro sense, we're all pretty familiar with the overall growth outlook. As Jeremy mentioned, China was the first to be locked down as a result of the pandemic. It was a serious lockdown. As a result, things recovered pretty quickly. So again, the only major economy to grow last year. And we're looking for a similar outlook for this year. You're sort of looking at forecasts that are generally sort of in that 8 to 10% type of range. What I think is encouraging here again is if you look at that breakdown of growth from last year, you'll see that consumption was not surprisingly a drag. So we did have help, obviously, from investment and from net exports. The hope is clearly that consumption drives the recovery this year, and all signs of that's clearly going to be the case. You've still got relatively elevated levels of savings. The unemployment rates are down, so I think the outlook for consumption to outgrow the overall growth in China still looks pretty strong. We just go to the next page. So I'm just going to touch on some of the broader themes in the portfolio. So again, sort of leading on from that discussion around just to sort of give you some of the data points around the longer term outlook for consumption. And obviously, this is sort of really core to the portfolio. And I think the reason that, a core theme that we're all investing around in China, and that's the natural growth of the middle class, that expansion on the back of rising incomes. And you can see on the top left there, just the size of the expansion of sort of population that's entering the middle class. You're sort of looking at population growth in those sectors that are bigger than most countries, including the US. And As a result of that, as you see on bottom left, obviously that's going to drive, is expected to drive, pretty significant growth in consumption. And that's why, I guess, obviously the domestic players, but even global players are very much focused on this sort of growth opportunity. In terms of what's helping support that growth in consumption, if you look at top right, sorry, and that's the urbanization rate. So, we're looking at sort of an overall urbanization ratio now of about 61%. In the 14th five-year plan, by 2025, there's a target to take that to 65%. And the gap in terms of both income and spending for rural versus urban is quite significant, by some numbers up to 60%. So that shift is clearly going to help drive that growth. And, stepping back, 65% is still relatively low in a sort of a global context of developed markets. So there's more room to grow after that. I'll also make the point that even within that sort of urban population, there are a significant amount of migrant workers, and many of them are not afforded the same sort of rights that the urban local population is. There's a thing called a hukou, or an urban registration. And so you've got maybe over 200 million people that are in large cities that don't have that. But there's a clear focus on the government to adjust that. You're seeing it sort of vary by city size, but that's clearly being addressed. So that can be, I think, another driver that's sort of underlying potential growth in consumption going forward. Next slide, please. So on to another theme in the portfolio, and this may not sound particularly exciting when we're talking about building materials, but I actually think the thematic is quite strong. We're seeing signs across many of these sectors of consolidation really getting going, and these are very fragmented sectors. So if you look at some of the top players, many of these areas, you're looking at sort of the top three players in that sort of around 20% type of market share. Now in the Western markets, you'll find that's closer to 80%. And as you can see, the winners are starting to really emerge, and I think our team has done a great job of sort of identifying the winners across this space. And I think there's real potential for significant growth. And many of these are actually quite good businesses. If you look in an area like paint, I should say that most of these companies are growing more in the B2B space. So this is supplying the big developers, which is in itself, that sector itself is consolidating, and they're consolidating suppliers. So, that supply to the big developers is what's driving growth now. But in an area like paint, longer term, this can be quite a good business, as you see in other markets on the B2C side. So it's an area where you can really develop a brand, get pricing power, and generate relatively high returns. So, with the current levels of sort of market share, you can paint a pretty strong picture for growth for the leading companies in this space over time. Next slide, please. Now, just the last sort of thematic that I wanted to touch on was just generally around capital markets in China. These, in many ways, are very underdeveloped, but there's again sort of significant growth potential here for companies that can sort of really capitalize on the opportunity. So on the left, you see sort of the general capital flows into A shares. So clearly, you've probably seen headlines around the sort of fundraisings that are happening in the domestic market in China around mutual funds. So you can see how those flows are coming through. But in addition, there's foreign flows into the market as well, which has also been relatively strong, as you see in sort of the northbound dotted line there, which is sort of the stock connect that you have connecting Hong Kong with the mainland, and you can see how those flows are relatively strong. But I should say, if you look at foreign ownership of the market in terms of the A shares, we're still at less than 5%. So there's really significant growth potential, for foreign ownership and institutional ownership of the market over time. And I think we all know that you've seen some of the index changes, the MSCI changes that are increasing the weight of China in global markets. I continue to believe that will drive probably the biggest shift in the indices geographically that we see really in the next decade. I expect that to continue. So I think the outlook in terms of flows for foreign flows into the market looks fairly strong. So in terms of the way to play that, I think the securities brokers, the local securities brokers focused on, particularly on institutions, I think is a really interesting part of the market. As I've said, the market is relatively underdeveloped, and going forward, there's good potential for that to develop. Things such as derivatives, deeper, derivative products to come into the market, and obviously a fairly strong outlook that we've seen around issuance, both on the equity side and the bond side. They stand well to benefit from that. As we know, the sort of Chinese indices, whether it be Hong Kong, Shanghai, or Shenzhen, they've been some of the biggest. That's where you've seen some of the most issuance of global markets in the last 12 months. On the right-hand side, again, just making the point that there's still good growth potential for domestic funds as well. If you look at the sort of the household balance sheet there, it's still very property focused. There's a clear focus from the government to take the heat out of property markets, and I think that's what's helping drive the flows that we're seeing into mutual funds. And there's specific ways to play that as well. I have holdings in a company called Noah, which I think is the strongest sort of independent wealth manager in China, and they've done a very strong job of vetting product, building relationships, building out a very strong sort of relationship management team as well. So they stand to benefit from that shift as well. Next slide, please. So just sort of breaking down the portfolio in terms of sectors. Again, you won't be surprised that, given what I've said about New China, that the likes of the IT space, healthcare, are pretty sort of core parts of the market. You might also notice that consumer discretionary, it's still a major part of the portfolio, at sort of a third. But that's actually come down over time, just given the moves that we've seen in some of the stocks of late. I've just started finding more value elsewhere in the market. I talked about areas like building materials, and that's what's driving sort of the increase in areas of that sort of part of the market. It's not a perfect delineation of the types of companies that we're investing in. Obviously, the consumer, is still a really core part of other parts of other index makeup. But again, just sort of, I think, highlighting here the sort of breadth that we have in the portfolio, and the breadth continues on the right hand side. We need to see where we're invested. We're happy to go wherever the companies are listed to sort of get access. It's really more about the quality, the business, where the revenues are coming from. That's much more important for us. But what I will say is that that A share part of the portfolio has clearly grown in the last 12 months. So investing in areas like the sort of building materials names that I mentioned earlier and some of the industrials, you'll find a much greater sort of congregation of those types of names in the A share market. And the A share market is very big. There's many parts that are not very well covered. So again, sort of leveraging that team on the ground, I think there's great opportunity to come from sort of accessing the opportunities in that market going forward. Next slide, please. So just in terms of the unlisted holdings in the portfolio, I won't go through all of them. In fact, I think I've probably run over time-wise, but just want to make the point that there's real opportunity in this part of the market. I think it's fair to say that sort of globally companies are coming to market later. So again, in sort of getting access to those opportunities, it's sort of important to be, I think, sort of focused on the opportunities that come through in that part of the market. And a good example of that would be, one that probably most people are familiar with, and that's ByteDance. So obviously the owner of two very well-known platforms. Well, one very well-known outside of China, and that's TikTok. And then that's then you have the Douyin platform in China as well, which continues to grow strongly. This company continues to march ahead. They're sort of if you look at sort of advertising dollar, they're number 2 now in China. So again, if you didn't have access to that type of opportunity, you're missing out, in terms of one of the investment opportunity, but also your understanding of the makeup of the market. So I think, again, that's very important to be focused on those types of opportunities. Again, ByteDance, by some measures, is probably the fastest growing company in history. It's compared to the likes of Google, etc. It's clearly growing much faster, and it's much bigger, at the same age, relative to sort of a lot of the big tech companies that we see in the West. Anyway, I think I'll stop there and hand it back to Jeremy.
Fantastic. Thank you very much, Dale. Lots of interesting stuff there. So next, a few questions from me, if that's all right. Firstly, recently, Chinese tech companies have been hit by more regulation or state intervention, as I expect lots of our viewers have been seeing in the news. Why are new China names like Alibaba or the ride-hailing company Didi Chuxing still good investments? Are you confident about the future of these businesses?
Yeah, I think just stepping back, clearly regulation around large tech companies is something that we're sort of, a lot of countries are dealing with as these companies have gotten bigger. So you're seeing, the two main thrusts of regulation around antitrust and around data security. So obviously, again, that's sort of increasing regulation we're seeing globally as sort of, these companies come bigger. I think you can make the point that China has probably lagged in terms of getting that regulation in place. So, I think it's sort of natural in some ways that that's coming through. On the antitrust side, I think, we're sort of probably further ahead in that process. Obviously, you've seen, the actions that have been taken, particularly around sort of forced exclusivity for merchants on platforms. So I think that's already been addressed. The likes of Alibaba have already paid their sort of well-publicized fine. So I think we're sort of further along in that sort of regulatory cycle. Around data security, I think we're sort of, earlier in that process. But again, you've sort of seen other regions, other parts of the world move ahead on that. Obviously in Europe, the likes of GDPR and that sort of thing is a factor as well. I'd say there's another element that's sort of entering the sphere around sort of data sovereignty. So increasing concerns about that sort of data, making it offshore, and I can delve further into that. But that's, I think, a newer phase that we're sort of entering. But again, the probes have begun. I think, as a result, it will clearly drive, more listings back to Hong Kong and the mainland. But at the end of the day, again, sort of stepping back, these these companies are core parts of the economy. They're some of the fastest growing companies, the biggest employers, the biggest investors, and the biggest drivers of innovation. And let's not forget that that's a key focus for the country overall. And you saw that come through pretty clearly in the most recent 5-year plan. They need to drive innovation. So I think we've been through these phases of sort of regulatory tightening before. We're clearly in the midst of it again. It's lasted a bit longer than previous cycles, but I think we're well into that process. I think there can be impact to some of the businesses, but a lot of them have very, very strong market positions, very strong market share, and they're providing key services. I think they're again very strong businesses that still have good potential to grow in the midterm.
Okay, thanks, Dale. Just following up on that, we've actually had a related question come in from one of our viewers. You've talked about how this is really part of global trends when it comes to tech companies, and we've seen these phases in China before. But this viewer asks, is it fair to say that Western investors have been rather blindsided by this kind of government crackdown on tech companies? Or is it something that's known and expected? And also just how much of a drag has it been to the trust performance, really, these trends we've been seeing?
Yeah, I think if you dig deep enough, the signs are there, and you look at the discussions. So I think if you're sort of following the legislation and the discussions, I think the signs are there that the sort of the regulation is coming. I think the more recent sort of actions from the CAC have been probably more surprising in terms of the speed at which things have happened. But I think in general, in terms of increasing regulation, I think it's fair to say that the signs have definitely been there. If you look at areas like fintech, the signs of early regulation around the P2P space have been there, and we shouldn't be surprised when you've got sort of a heavy regulated sector like banking and sort of an area of fintech that's been relatively unregulated. That sort of gap is increasingly going to sort of close over time. In terms of the drag on performance, I don't have specific numbers around that. Clearly, on some stocks, there has been some correction, and obviously recent listings, the likes of DD, etc., have been impacted. But stepping back again, obviously we've been invested in the company for some time, and if you look at the sort of long-term performance and contribution of that type of holding, it's still been a clear contributor over time. So I wouldn't say it's been a sort of a wholesale factor driving lower performance for the trust.
Okay, well, great. Thank you, Dale. Next question. So shareholders have recently backed a move to allow more unlisted investments in the portfolio. Can you explain why you want to invest more in private companies and what kind of opportunities that might unlock?
Yeah, I mean, the key thinking there is mostly around flexibility. So obviously, as I've discussed, we want to have that flexibility to really capitalize on the opportunities. Our holdings in the trust, I think at one point were over 8%. And it's not like, we continue to look at opportunities, and a lot of opportunities, but it's not like we need to go above 10 now. But we want to have that flexibility. And as I've said, there's significant opportunity out there. We continue to meet with companies. There's a lot of innovation that's happening on the ground, and it's across a range of sectors. Obviously, our core focus or the key opportunity set for us has been in technology, but in areas like healthcare, in those types of areas, there's again a lot of activity. So, it's just really about having that flexibility to capitalize on the opportunities should they come through.
Okay, thanks, Dale. We've touched a bit on this in your presentation already, but China was much more successful than most Western countries at suppressing COVID-19, and its stock market was one of the best performing in the world last year. Should prospective investors be worried they're getting in at the top, or are valuations starting to look more palatable now?
Yeah, I'd come back to the chart I showed earlier on valuation. So I think it just from a pure valuation perspective, there's probably not the same bargain set that there was sort of 12 to 18 months ago, but still on a relative basis, there's decent opportunity. I've still got companies in the portfolio that sort of on that sort of single digit multiple, and that's what reflects the sort of relatively high gearing in the portfolio. So I still feel there's definitely still opportunity, and I'd say also probably in some ways a relatively clear economic backdrop. Given that the pandemic is sort of very much under control, sort of monetary policy is normalized. It's kind of normal in a way, from that perspective. So we can sort of, I think, comfortably set back and focus on the sort of opportunities that we've talked about today.
Yeah, and since last year, you've been tilting the portfolio a bit more towards less loved sectors like textiles and materials. Tell us a bit more about what's behind that shift, and what does it mean for the balance of growth and value in the portfolio?
Yeah, as I talked about the sort of factors that I look at in any investment. For all those factors, you're looking at, I should have mentioned, you're looking at all that versus what you're paying in the portfolio. And so we had a period where I felt the market was quite narrow. A lot of the large growth companies had done quite well, and the valuations were stretched. And then you had these other parts of the market which were neglected. And again, then probably not as as thematic or appealing in many ways, but a lot of these companies have really strong businesses at great valuations. So it's just with the team is always weighing up risk reward and just the risk reward that we're following in these more sort of neglected areas of the market. We're presenting opportunity, and that's what is driving that. And then there's clear fundamental stories there as well. Like that whole consolidation angle around a lot of the materials companies, I think, is a strong thematic, and it's a thematic that we can look to play out over 5 to 10 years without a lot of the sort of technical and regulatory risks that you'll see in other sectors.
Yeah, and you mentioned to me the other day that after a bit of a pullback in highly rated areas like tech, actually valuations look a bit more appealing there now as well. So is that a bit of a challenge for you now in terms of how you allocate capital?
It is. So I wouldn't say a challenge. I think the opportunity set there is increasing now, just given the corrections that we've seen. So you've seen 50%, if not more, moves down in some of these companies. Obviously, sentiment wise, there's a lot more fear out there in the market, and that's what's driving that. But again, I talked about sort of the long-term view for these companies. If you look over time, we've been through these sort of regulatory tightening periods before, and generally, that's in the midst of that process has been a pretty good time to buy. If you're sort of looking back through that, and so now I'd say also, if you look at the valuation, the way the valuation gap has opened up globally. So if you look at some of these companies versus their global peers, just how they've underperformed, whereas a lot of the global peers have marched on. I think there's a compelling sort of relative value case that's emerging there for those companies as well. So, we're sharpening our pencils and looking at potential opportunities for these companies.
Okay, thanks, Dale. Very interesting picture. You've mentioned a bit, but somewhat unusually, the trust doesn't just buy shares, but uses some options and takes short positions too. To some, that might sound like the territory of a hedge fund. What's the rationale for doing that? And actually, we have had a question from a viewer named John. Says, under what circumstances do you look to take short positions? So if you could just address that, that'd be great.
Yeah, sure. Well, I showed you the team. We're out there looking at companies. We're looking at all opportunities. We have some of the analysts who focus purely on short opportunities, but I feel we should be leveraging our research in all areas. So in those cases where we find that we think companies are very overvalued, then obviously the risks are higher, so we need to manage position size. But we should be there, looking to capitalize on those potential opportunities. And it really comes down to risk reward. Obviously, on the long side, it's about risk reward. I think it sort of works in reverse on the short side. So you're naturally attracted to areas where expectations are very high, valuations are very high. I think areas where we would have questions about corporate governance, where we'd have questions about some of the accounting and that sort of thing. I think that can come together to provide opportunity on the short side. So again, it's about leveraging the resources we have, the research that we're doing on both sides, really.
Okay, thanks very much, Dale. Now it's nearly time for the Q&A, so please do keep submitting your questions. I think we've had lots of great questions already, so please keep them coming in. While Michelle finalises those questions, we have one more question for you at home. That is, are you likely to increase your allocation to China this year? Yes or no? Dale, while the results are coming in, something else I wanted to ask you. I think in the past you would have travelled to China pretty regularly, but in the last year and a half, you for obvious reasons haven't been able to so much. Has that made your job more difficult?
It has in ways. I mean, I think there's been positives and negatives. So a core part of my process is meeting with companies, and I think initially we were very concerned about how this would hamper that process. I've got to say we were sort of pleasantly surprised by the reaction of companies. So we found the companies very resilient, very quick to move online, and this is sort of across the broad spectrum of companies. So we were able to shift the research process online pretty quickly, and then obviously our team on the ground is out meeting companies, but you do still miss something. So I'm looking forward to sort of getting back to, particularly for that first meeting with companies, getting on the ground, getting out, seeing them at their place of work, seeing, even things like how management themselves sort of interact between each other and things like that. So, I'm sort of definitely looking forward to that. On the plus side, clearly, we're all Zooming all day. We're just covering more ground. We're just, there is a fair bit of lost time when you're on the ground in China, getting out to these, oftentimes third and fourth tier cities. So the fact that we're just, able to jump online means I think we're covering more ground. So yeah, pluses and minuses.
Okay, well, thank you, Dale. Okay, so the results pretty much in, I think. And okay, a lot of viewers are keen to increase their allocation, but also a few still in doubt. So on that note, Michelle, how are we doing for questions for the Q&A?
We've got plenty of questions that have come in, understandably. Great. There are, Adele, hi, there are a few concerns around China, as I'm sure you're aware at the moment. Investors are a bit concerned that it's an increasingly hostile environment to invest in. So maybe we'll tackle those first. Bob has got a great question. He's straight in there. He said, what would happen to the fund if certain US listed China shares had to be delisted from US markets?
Yeah, good question. I think, we're seeing, you've seen already a lot of companies that are listed, a lot of the big ones have already have dual listings back in Hong Kong. And, we've seen some of the requirements on the Hong Kong side sort of be lowered. So I think, again, there's clear, encouragement for companies, I think, a pretty clear message to that they're welcome to come home. So I think that the likes of the onshore markets and particularly Hong Kong are going to be waiting there to welcome these companies. There could be issues with some companies. I think generally the hurdles for listing in Hong Kong are higher. Like I said, some of those are being addressed. So I think there could be issues for some companies, but the general way we see things in terms of those discussions playing out is that that's likely to last 2 to 3 years. So there's going to be a window for companies to make that transition. For any company, if it was not able to do it, as long as the business is strong, I'm sure the likes of a few private equity funds would be happy sort of waiting there in the wings to take them private before they listed in sort of those Asian markets if that opportunity was available. But I think for the vast majority of companies, that opportunity to list back home is going to be very much available to them.
Thank you. And so that segues nicely into a question from Stephen Lee. He says you have 68% invested via Hong Kong. Is that a concern given the growing influence of mainland China?
I don't think so. I think Hong Kong is a really a very strong market. I think the incentives are there to keep it as a sort of a world-class financial center. And I think again, all these signs are showing just how important Hong Kong is. And I think any companies that that are currently listed in the US, that option to list in Hong Kong will be there. And I don't really see how sort of having that listing, in Hong Kong, would be a factor in sort of realizing value for the companies. If you look at, the way the dual listings and that sort of thing have worked, it's a very much sort of an open market, and I think fully supported.
Thank you. And finally, kind of on the broader China picture, Adrian Chard would like to know, in view of the recent knock on the price caused by the Chinese government crackdown, as it's been described, is the fund too volatile to hold for even quite adventurous investors, exposed as it is to the vagaries of Chinese political whim?
Well, I mean, it's a geared investment trust investing in a one country, market. So volatility is going to be there. I think it's sort of natural, and it's not always a bad thing. We can definitely capitalize on volatility in the market. We have that ability to control the gearing. So, in those periods of volatility, I think it actually creates opportunity. I'm still very much of the belief that, stock prices do move with, the creation of value over time. So, if as long as the companies are executing, that should get recognized in stock prices over time and get reflected in the NAV over time. But again, it's not going to be a straight line. There will be these periods of volatility. We've seen it before, and in most cases, it's an opportunity to sort of, again, leverage the tools in our disposal to capitalize on the opportunities.
Thank you. And it's not just Chinese politics and policy that is concerning our viewers today. Mark Proudfoot has asked, China has been forced to build chip foundries and increase self-reliance. Is the trust taking positions in companies which are rapidly expanding as a result of US policy?
Yeah, it's a really good point. And, I think we do need to watch how the policy plays out. I'm quite, I think we spend a lot of time looking at supply chains. So any company that relies on, particularly sort of leading edge technology from the US, I think you need to be wary of. That's why, the core thrust of the portfolio is really focused on the domestic opportunity. When we aggregate the revenues for all the companies in the trust, over 90% or around that level are generated from China. So I think it's important to be focused on the domestic opportunity. In terms of China, investing heavily in areas like semiconductors, it's an area we spend a lot of time working on. I'll be very honest in saying we struggle a bit with the valuation of some of the companies, and relative to their sort of stage of development. So, many of them are sort of from a risk reward perspective don't stack up, but there are opportunities definitely in the portfolio. Where we see, lots of potential support, sort of emerging companies with strong technology that can survive and grow and prosper, just in the Chinese ecosystem. So there's definitely opportunities there as well.
And you're painting a very rosy picture for the Chinese outlook. Neil has asked, some US-based commentators are saying growth and inflation in China are slowing and regulatory risk is growing. Do you agree?
Yeah, I think in terms of slowing growth, I think we're definitely in a phase of slowing growth. I don't think that should be expected. We've had a lot of stimulus which drove growth up, sort of coming out of COVID, and obviously on a year-on-year basis the numbers are high. So we're getting tougher comps, tougher comparisons as we sort of move throughout the year. So it's natural that growth slows, and to be honest, every country is going to see this cycle. I think China's just moving ahead. So it's natural that growth slows, and that's why I think you've seen recent moves to loosen at the margin. The RRR cuts are a sign that, okay, we've seen sort of growth slow. There's some signs of loosening, and I think there's going to probably be a little bit more of that. I'd just be a little bit wary around some of the numbers. I think a few people were spooked by I think it was the June services PMI, which dropped. I think it was sort of in the 54 range down to 51. I think you've got to remember that there was a lockdown in Guangdong province towards the end of May and into June. So that, I think, it's a very big province, and so given what was a pretty significant shutdown, I think there's probably some impact from that in the numbers as well. So yeah, I think growth clearly is slowing. I think the quality of growth again over time will improve. As I've said, whatever your final sort of growth forecast for China is, I think it's fair to assume that consumption is going to grow faster. So again, I sort of come back to, investing in an economy with, probably sort of that sector growing sort of high single digit with a lot of structural change. It's not a bad backdrop for picking stocks in a pretty diverse market. So, again, I think, we need to watch the growth numbers. I'm actually encouraged that the government is still focused on keeping debt, sort of overall debt levels, in a reasonable range relative to GDP, not sort of limiting the sort of debt-led growth and investment. So I actually think policy-wise, that's a pretty sound policy for the midterm.
And we can't talk about growth without having a question on inflation, ever-present inflation. And Philip Taylor would like to know, how confident are you that any potential inflationary measures in China will not be to the detriment of the fund?
Yeah, I think inflation is something we definitely need to watch, and it's obviously clearly not just a China thing. I mean, I think you can apply that question around inflation to sort of to markets globally. I think if you focus purely on CPI, China does have somewhat of a benefit in, a lot of that is food, and a lot of within food is pork, and we're sort of cycle-wise at a point where pork prices are actually, supply is increasing, and pork prices are actually, have been on the decline. So there's probably less pressure there on the CPI side relative to PPI. But it's something we definitely need to watch. I think about it more from a company level. So if there are inflationary pressures, how is a company positioned to pass on those price increases? That's, for a company level, most important for me, and that's again a core part of our process is focused on competitive advantage that feeds into pricing power. So ideally we're owning companies that, should there be cost pressure, are able to pass on those price increases or cost increases.
Thank you. We've also got lots of sort of portfolio specific questions as well for you, Dale. And I'll just kick it off with an anonymous question. This person has asked, the trust hasn't performed over the last 3 months. What measures have you taken to turn this around?
Yeah, I mean, we continue to, just invest as according to sort of, the principles that we talked about. It's about, obviously you have your sort of ups and downs and performance wise, but as I've said, if you're investing at reasonable valuations for companies that can execute over time, then, the companies should perform, the stock should perform. So we continue to, apply that sort of risk reward lens across the market. And, we have seen some pretty big sell-offs in certain stocks. When that creates opportunity, we'll be capitalizing on those opportunities. So yeah, I mean, we think about, performance in the long term, and again, in our experience, as long as the companies are executing and the valuation's reasonable, then, that should get reflected in stock prices, and so the NAV over time.
Thank you. There's also lots of interest in kind of the racier elements of your portfolio, the shorting in the private companies. And on shorting, the kind of what it boils down to, it's what the viewers want to know is what has the performance of your short positions been over time relative to the overall portfolio? Yeah,
I mean, the shorts have been a slight lag on performance, a slight drag, I should say, on performance over time. But I think you've got to view that in the context that, we've been through a pretty strong market. So it's sort of, it's generally sort of not the time that, you're probably going to get, the greatest sort of bang for your buck out of the short portfolio. But, I think in a sort of different type of environment, there's more potential for that to add to performance in the longer term.
Great. And on private companies, Andrew Wynn has got 2 questions here. He wants to know how large an allocation to unlisted companies can the fund maintain, but also at what stage of investment are you investing in private companies, whether that's growth capital or late stage, please?
Yeah. So with the recent change, we have the ability that was passed at the AGM to go to 15%, but obviously the board is watching that closely, and sort of obviously we will look for their approval and sort of going beyond that 10% level. In terms of the types of companies, generally it's later stage. So generally later stage companies, as opposed to sort of the growth capital sort of part of the market, it's generally later. And obviously, unlike a lot of companies that are investing in that space around the sort of private equity companies, we can continue to hold the companies post listing. There's no reason for us to be to be selling. We can hold them when they become listed companies.
Fantastic, and that probably rolls on nicely to John G's question. He wants to know what exit strategies have you put in relative to your unlisted investments? Is it that you're just waiting for them to list?
We'll look at all opportunities. If there's I think it's fair to say that the IPO is probably the more mainstream exit strategy. But there's if there's a potential trade sale or other potential exit opportunities out there, we'll definitely look at them. But from a pure sort of value realization point of view, the IPO has been sort of the way that we've generally sort of not exited, but sort of realized value, and sort of moved companies into the sort of the public realm. That's generally sort of been the way we've been able to exit over time.
Thank you. And I've also got
if we need to exit, I should say.
Sorry,
if we need to exit, we don't always need to exit.
Okay, that makes sense. I've also got a currency question here. With all the money printing in the West, how much of a role will currency play in the longer term returns of the trust over 5 and 10 years?
That's a really, it's a really tough question. I'm obviously focused on the individual companies and sort of the potential value that they're creating as opposed to sort of currency. But as you've said, just sort of given interest rate differentials, I think there's probably over time more potential for the currency to appreciate than depreciate. But it's not. I mean, I think it more on the company level. I think about the risks around what currency valuation shifts could mean for potential earnings, the risks around that. For me, it's much more about the company, about what's happening at the company level and how that can impact earnings and balance sheets for the individual companies.
Thank you. And just to finish off on the viewer questions, nice one to sum up maybe. What sectors are you most excited about for the rest of the year, and which sector do you think maybe could cause a bit of a problem, please, Dale?
Yeah, interesting question. I continue to think, the bets that we have in the material space, I think, are still look good. The question is a bit more short term, so these are I think are sort of more longer term types of stories. In the shorter term, I think it's worth doing more work on the tech space. I think going forward, there's more potential for uncertainty to be reduced around the sort of operating, the sort of regulatory environment. And at a time where a lot of companies have been sold off around these concerns, as we get more certainty around that type of area, I think it's going to definitely be presenting opportunities. Problem areas, I'd say I think there's some areas where valuations are looking relatively stretched. There's parts of the auto market, including the EV space, where I think valuations look relatively stretched. There's even parts of the consumer space that are starting to get up there around, and in terms of valuation. I think that's where you could see some potential disappointments.
Thank you.
Great, thanks very much, Dale. One last quick question from me, if that's all right, and I'll have to ask you to give a fairly pithy answer if possible. During the last year and a half, in global markets, a lot of the talk has been about lockdown winners, reopening winners. Life may have been back to normal in China for a while, but how has the behavior of the Chinese consumer changed over the last year?
Yeah, I think to keep it short, I think it's the same as generally what we're seeing sort of globally. That shift online has just accelerated. So a lot of the activities that we moved online have accelerated. The probably difference in China is the delta is lower because things were already moving pretty quickly sort of online anyway. But I think that's probably the biggest change. And then the areas that still have potential to change would be travel. I think people are generally sort of most of the travel has been domestic. Looking forward, I think there's a lot of people who are looking to, when things open up, sort of travel internationally as well. I'd say there's probably more work from home, but my sense is on the ground in China is that people are sort of much more back to the office and sort of what we're hearing in the West.
Okay, well, thank you very much, Dale. I think sadly we need to wrap it up there. So yes, that's all we've got time for, I'm afraid. So thank you, Dale, for your time and sharing your investment insight. Thanks, Michelle, for moderating the Q&A. And thank you for watching and submitting your questions.